Taxes, so much to know and so little time to learn it all. If you're a small business owner, you feel me. And when it comes to your estimated taxes, you're probably thinking, dude, don't tell me that I need to pay yet another thing. Tell me, what are estimated tax payments and why am I paying these things? Well, lucky for you, because today I'm breaking down everything you need to know about estimated tax payments for small businesses. After this video, you'll know what estimated taxes are, how to figure out how much you need to pay, and of course, how to actually make your payments. I've been teaching small business owners about how to manage their business finances for over 10 years. So if taxes make you want to bury your head in the sand and scream, don't worry. I'm going to break this stuff down so you understand it and maybe even feel a little like a badass when you talk about it. Before we begin, I would love to gauge where everyone is at with their tax payments. Tell me, are you making your estimated tax payments? Let me know yes or no in the comments below. What are estimated tax payments? Your estimated taxes, which are also called estimates or quarterlies, are payments that you make throughout the year towards your final tax bill. Here's the thing, we don't know how much our tax bill is going to be until we actually file our taxes. So all payments that we make towards our tax bill are estimates. Yeah, the IRS is real original like that. The IRS doesn't want to wait around to collect your tax payments, less because they have a deep burning love for you and more because they want to get your money as you make it. So this system of estimated taxes requires that self-employed people and small business owners make quarterly payments towards their taxes, which is kind of like an installment situation. You make money and every quarter you send an installment payment on what you've earned to the government. Now, even though this is a requirement, estimated tax payments are actually really good for your finances. It spreads your tax payments out across the year. Taxes can get very, very expensive for self-employed folks especially. And getting hit with a $20,000 tax bill all at once is painful. So paying your taxes in installments actually benefits you and your cash flow because it ensures that you're not sucking your business dry at tax time. How do estimated taxes work? Throughout the year, you pay estimated taxes 4 times. Then at the end of the year, you file your taxes. Once you file your taxes, you'll know how much you owe the government. This is where your estimated tax payments come into play. All the payments you've made throughout the year are applied to your final tax bill. So if you owe $15,000 in taxes and made $12,000 in estimated tax payments, well then you just have to pay the difference, which is $3,000. On the flip side, if you overpay your estimated taxes, then you get a refund. It's like the holy grail of tax situations. Or you can skip the refund and apply the overage to your next estimated tax payment. That's right, estimated taxes never go away because they are based on tax year. Every year you're going to have to make a series of payments. So settle in because you're going to be doing this for a while. Who has to pay estimated taxes? If you're self-employed, which means you have non-employee income, then you will most likely need to pay estimated taxes. If you're confused about what self-employment income is, I've linked to a blog post that talks in depth about self-employment income below. And before you start grumbling, why do self-employed people have to do this when regular employees don't? Slow your roll, because everyone is actually in some way making estimated tax payments. Employees have taxes withdrawn from their paycheck every time they're paid. The difference is that as self-employed folks, we don't get a paycheck, which means there's nothing to withhold, which means that we need to take the initiative and pay our estimated taxes. Okay, but back to estimated taxes. So if you're self-employed, then you're already well on your way to paying estimated taxes. The next qualifier is that if you think you'll owe more than $1,000 in taxes at the end of the year. So basically, if your business is relatively profitable, then you probably need to pay estimated taxes. So what happens if you just blow off your estimated taxes? Well, then you get hit with a penalty, and that's a bummer. How do I know how much I need to pay? There are two ways to figure out your estimated tax payments. The first is by basing it on your previous year's taxes. After you file your taxes, you should receive a form that tells you how much to pay every quarter. Now, if your income is consistent year to year, this method should work fine. But if your income fluctuates or you have a growing business, which we hope you do, you definitely want to calculate your tax payments yourself. Here's why. Let's say you make $40,000 more this year than you did last year, but you're making payments based on last year's numbers. Well, you're going to have a huge difference between your estimated tax payments and your final tax bill. Personally, I like calculating estimated taxes in real time. I just think it's more accurate and it allows you to make payments based on what you're really earning at the moment. So, how does this second method work? Well, first you need to know your net income for the period of your estimated tax payments. And figuring that out is pretty easy. You would just run a profit or loss report in your bookkeeping program. If you don't have a bookkeeping program, you subtract your tax deductions from your total income, and that gives you your net income. Next, you're going to divide this number by 30%. 30%, yes. So here's why it's so high. First, your estimated tax payments are also going towards your self-employment tax, which is a whopping 15.3% of your net income. Your estimates also cover your income tax. Your income tax depends on your tax bracket, but 15% tends to be a good middle-of-the-road estimate for most people. If you know you're in a higher tax bracket, you may need to up the percentage to 35%. And if you know you're in a lower tax bracket, you could decrease the percentage to 25%. Here's how it looks in practice. You have $25,000 in net income for the first quarter of the year. You multiply that by 30%, and your estimated tax payment is $7,500. How do I make sure I have money for my payments? So after this example, you're probably like, what WTF? How am I supposed to have $7,500 lying around every quarter? The answer is by saving for your taxes every month. So while you only need to make estimated tax payments every quarter, you should be saving monthly for your taxes. And the process of saving monthly for your taxes is pretty similar to the second method for figuring out your quarterly tax payments. You'll need to know your net income for the month and also your tax savings percentage, which again will be somewhere around 30%. Then you take your net income and multiply that by 30%. That's how much you should save for your taxes. I recommend you put your tax savings into a separate tax savings account so you aren't tempted to dip into it. Then when it's time to make your payment, you transfer the money from your savings into your checkings, and there you go. You've got the money for your payments. Trust me, it's way less painful this way. How do I make a payment? Now we're to the most depressing part of this entire process, where you actually have to part with your money. But before we talk about how you make your payments, let's talk about when your payments are due. The estimated tax payment due dates are April 15th, June 15th, September 15th, and January 15th. And anytime one of these dates falls on a weekend or holiday, the due date will move up to the following Monday. Now, how to make your payments? First, you can go all old school and pay with a check. When you pay with a check, you do need to include a 1040 ES form that basically gives the government your information so they can apply the payments to your taxes. The second way, and my preferred method, is to pay online. There are two websites you can use, and they both do the same thing, and both of them are free for you to use. The first is the IRS Direct Pay website, where you can pay via your bank account. And basically, you just go to make a payment, enter in your taxpayer information and bank information, and that's it. You've just paid your estimated taxes online. The second site is the EFTPS, which is a mouthful, where you can pay via credit card, but there is a convenience fee. So however you pay, it's just important that you actually pay. And my number one tip for you is to save for taxes monthly. That's the thing that will make this entire process more manageable, and you'll be in a routine of dealing with your taxes on a daily basis, which means you're not going to forget about them. I have something super special for you, my Biz Finance Survival Kit. It's free and not only comes with a tax write-off cheat sheet, but also with 4 other cheat sheets and checklists for your small business. You can download it for free using the link in the description below. Also in the description, I've linked to a bunch of resources and blog posts to help you get clearer on some of the concepts we talked about today. If you like this video, let me know in the comments below. What was your biggest takeaway? And make sure you subscribe to my channel because every week I share a new video about how to organize and stay on top of your business finances. I'll see you in the next video.